That quick update, 19,500 plus on the Nifty. So yes, as Surabhi said, some semblance of a bit of a pullback is what we have. Srinivas Rao Ravuri is Chief Investment Officer at PGIM India Mutual Fund, and he's with us to take some questions. Srinivas, good to have you with us here. Good afternoon. They say buy when there is blood on the streets. I mean, I think there's only a hint of blood. I mean, it's very a drop, maybe half a drop. But are you buying anything? What are you doing? And how are you looking at the entire picture?
Yeah, good afternoon, and thank you for having me here. I am pleasantly surprised and also, but happy to see this, I will not say blood, but correction. I think this is much warranted. I've been waiting for, I think most of us are waiting for quite some time. Though as a fund managers, we all will be happy to see market going up and investors seeing their NAVs giving good returns. But I think what we've seen in the last 3-4 months is a bit of an exuberance, I would say. If you see, let's say the 3 months returns, large cap versus mid cap versus small cap, large cap is 15%, whereas small cap was 30%. So I think there is clearly a bit of excesses that got into the markets in the last few months, led by we've seen every month FIs investing almost $3-4 billion. It's been a fantastic rally led by that. And B, I think, which is also equally important, which is what makes us to remain positive on the long term. I'm saying Indian economy is doing extremely well, and same is reflected in the corporate earnings also. Right now, about 70% of the Nifty companies have delivered result for the first quarter. And if you see the numbers, the top line growth is about 8%, whereas the EBITDA growth is upwards of 30% and profit growth is upwards of 40%. There is a base effect that one need to take into account. But overall, 15% earnings growth for the current year, it seems to be very much doable, and companies have surprised positively versus the expectations. So the underlying economy is doing well, but when you see the kind of rally that we've seen in the last few weeks, I would say a correction like this is most welcome.
Srinivas, you said there are excesses, there are signs of exuberance in the market. Have you used this rally to trim your holding in any sector, stocks, themes?
Yes, definitely. Wherever we saw stocks, I would say rallying up a lot and going out of what we look at as a fair value, we have reduced exposure or pruned exposure to book profits. That's what we are supposed to do, Reema.
Is in which sectors or stocks have you pruned your exposure?
So I would say, consumer and industrials. I think these are the two sectors where we have seen, we have looked at reducing exposure, though very, very reluctantly, because, especially the capital goods or the industrial sector, we are clearly seeing the revival of capex cycle. Manufacturing sector will do well. But as a fund manager, our job is not just to buy companies that will do well, but we will also have to buy these companies at a fair prices or below fair value. Even though the next 2-3 year outlook is very, very positive, but when you see the valuations, one simple metric, price to earning, all these companies are now trading above 50 times 1 year forward earnings. So I think that is one simple metric one can keep in mind. So if next 2 years growth is already factored in, one should actually be cautious and prune exposures. I think we have seen, in the last 2 years, chemicals is one classic example when everybody got bullish, excited. But if you see last 1 year returns have been very, very meager. Same is the case with, let's say, manufacturing, electronic manufacturing. So I think growth is important, but at the same time, when you see, this is what market tends to do. When you see that things are going a bit on the excessive side, we need to reduce exposure. That's what we've been doing.
Okay, got that. So that's where you're reducing exposure. But tell us about some themes where you're willing to go in as well. Anything interesting that's crossed your radar? I mean, we were speaking with some of these EMS companies earlier. Defense has been doing exceedingly well. There are a lot of new listings as well. What's new on the mind, Srinivas?
Unfortunately, very few in terms of new additions, Surabhi. I think financials and pharma, I think these two is what I've been positive and holding on for some time. So remains so even as of today in the international mandate that I manage right now. So I think pharma, especially, we've seen a very strong rebound in the US generic markets. But in terms of new names, I would say, given the way market has behaved in the last 2 months, been cagey about adding new names at this point of time.
You know, just a quick one, Srinivas. Aren't this entire capex theme also very expensive now?
Yes, I think. See, when I'm having let's say even a 12 to 18 months view, I would say it is expensive. But let's say if you want to say 3-year, 4-year view, maybe they are not expensive. But I think the moment you look at 3-5 years and trying to extrapolate what has happened in the last 6 months, 12 months to next 2-3 years, I think the margin of safety is definitely much lower. So I think that is where risk reward is not in the favor of investors to get in whenever market is trying to factor in 3-4 years growth ahead. I think my style doesn't suit that, so I would like to stay away.
Srinivas, thank you very much for joining in. Look forward to another conversation very soon. But that's the view coming in from PGIM. A bit of excess, a bit of exuberance in the market, and they have reluctantly pruned down their exposure to industrials and the consumer space. Let me quickly talk about Bharti. Bharti will be reporting